Hi guys, welcome to Hustlefreewealth. If you think SIPs are only for small ticket sizes, today's guest will change your mind. Joining me is Gajendra Kothari, who is co-founder of Etica Wealth, and he's on a mission to make India smarter with money. He's an advisor who walks the talk, famously committing to a 40 lakh SIP. I'll be asking him if that has changed. We'll be covering most of the questions that you get about mutual funds, asset allocation, and plenty more depending on the time we have available. Can you share with us how much is your current SIP and what's the portfolio worth today?
Sure, Pankaj. So, thank you for having me. It's a pleasure
Like,
to share my thoughts and insights with your viewers. I believe most of them are from the corporate world, uh,
yes.
right? And
Yes.
so I've been doing SIPs since last 15 years now. Started in 2010 and started with a very small amount of 10,000 rupees. And that was the time when I started my own entrepreneurial journey of a wealth management firm. And I really believed in this wonderful vehicle of mutual funds. Uh, though by the time I started, I was a CFA charter holder, MBA finance. But I realized that making money from stocks requires time, patience, knowledge, interest, everything. And then after also, you require a lot of amount of luck as well. So if in India, the fund managers over the last 10 years, 15 years have done a fabulous uh, kind of given a track record, then why should I really bother? And I'm happy, let's say around at 15% return, which is a very good return over a long period of time. In my case, given my risk profile, of course, we don't recommend 15% return for anybody. But because I've been into this industry, I understand market cycles and I have a long term view. So I said, if I can earn 15% return over a very long term, I think that's a very good portfolio builder. So I started with 10,000 SIPs. The only good thing I did was I never bought any large assets. Generally, people at age 30 end up buying a house, a big fancy cars, and end up breaking their investments or using that money to fund those goals. I was frugal. I was living in a rental house. Me and my brother, we worked hard on our business, and the SIPs kept on growing. So whatever we earned from our business, it went back into SIPs. So 10,000 became 50,000 and then a lakh, then 3 lakh. So first few years, the growth of SIPs was very slow, Pankaj. I would say up till 2019, the SIPs would have been sort of less than 8, 10 lakhs kind of thing. And just like
18 lakhs
per month, I'm
per
talking about.
month.
Okay, yeah. So you have to give the context also. But yeah, so me and my family, we're doing cumulative SIP of around 10 lakhs. But the major jump came in the last 5, 6, 7 years, just around COVID or before that. Our income grew substantially over the years. And as I said, everything that we earn from our business goes back in SIP. We don't buy direct stocks. We don't buy any other things. So hence it has to come back to SIP. And every March or April, around April, we increase our SIPs. So this April, we increase it to around 41 lakhs, 20,000. That was the kind of rough number. Generally, we try and stick to this number for the entire year. Uh, and we reassess in next March what should be the income for this year and how much more we can go with. Generally, we've been doing increasing at 20% per annum rate growth. Uh, because क्या होता है, beyond a point, your expenses doesn't increase much. And because you have always lived middle class, and it's not that we have been uh, not enjoying it. We also want to have good life and we enjoy, but we have done it smartly. I mean, and in that case, not purchasing house was the biggest uh, reason that it gave us so much more leverage and monthly cash flows that has helped us. Uh, and what I believe is our active income will continue to go up because we're entrepreneurs, because very passionate entrepreneurs, not just entrepreneurs, passionate. We work even very hard today. Not that we need to work hard, just like I believe I've seen one of your videos that you're also financially independent, but you continue to work, right? Because what do you do? घर पे बैठ के करोगे क्या? And if you can educate world, if you do whatever you like, I mean, that's why you've taken this and side hustle or whatever you can say. You love uh, educating public, so you're doing this. And if you can get paid for that, why not? For doing good work, right? That's a bonus. So we love what we do. We're getting very smartly paid for this, and we'll continue to do this for the rest of our life. So as long as our active income will go up, whatever surplus we earn, we'll keep doing SIPs, and hence this SIP would keep going up over a period of time. The reason why I'm doing this is very simple, because I'm a wealth manager, and I am trying and tell people that you should invest your money in mutual funds. Is because, am I having enough skin in the game? Am I believing in what I'm telling the world? And not just believing in, have I created my own wealth through this journey, right? Uh, if I tell people that in the long term you can expect 15% returns, have I kind of gained that kind of returns in my corpus over a long term period? And through that, have I built wealth through the power of compounding? So that is why uh, if at some point of time this corpus might become 100 crores, 200, 500 crores because of the game of compounding. We've seen portfolios of Rakesh Jhunjhunwala, Ramdev Agarwal, many others, their portfolios have grown. So I have gone much beyond the fire number, and I'm not race also that I need to build 100. It will be a natural path. This is the game that I'm playing, and I enjoy this game, and I believe that through this story, if even 5% people can get inspired and start their journey, I think I would feel that okay, the work was worth doing.
So, thank you, Gajendra, for sharing that. So my next question is on your style. I'm not sure if it is true or not, but I did hear somewhere that you look at sectors and then style of investing like value, momentum, quality, whichever is not working right now. So you kind of start SIP in that and you load up more of that in your portfolio. Is that true?
Yeah, that's true, because I'm a contrarian investor generally. I always believe Howard Marks says two things, that there are only two truths about markets. One is markets will always be cyclical, and second is markets will always be volatile. So if equity markets are not volatile, then they're not equity markets in that sense. If they're operating more like fixed income markets, like hardly any volatility, then there's no fun. Generally, you create a lot amount of wealth only when it is highly volatile, right? Because that gives you opportunity. Secondly, markets has to be cyclical. There has to be, because this is a game of supply and demand, because this is a game of greed and fear. Sometimes, and that's why we have this image of bull and bear. Sometimes bull becomes heavy on the bears and vice versa. So it's finally an emotional game. Hence, stock markets are not rational, at least in the short term. It's more of an emotional. And hence you get these opportunities from time to time. So if you're a contrarian, if you can see those opportunities and go against the crowd. Generally, I believe in stock markets, generally crowd is not smart. And that's why crowd never makes money in stock markets. Retail investors hardly makes money. If you can go against the wisdom of the crowd, you can make a lot of money over a long term. In last 10 years, 15 years, that has worked wonderfully well for me. And when I go contrarian, people think I'm taking higher risk. Actually, I'm taking low risk, because I'm buying something which is really cheap, which has not worked in the last 3, 4, 5 years. And I'm paying much lower price for that. Of course, at the levels which I buy, it can go down further 10%, 20%, 30% from there. But because I'm buying a basket, I'm not buying one stock. I'm averaging the entire sector down, or that country down, or whatever, that theme down. So, and that has so far worked. It can take a lot of time for that to play out, 3 years, 4 years, 5 years, even 10 years. But I have unlimited patience, so I can wait for that.
There is a question on that. I'll be asking you, first of all, how do you select that? But before I ask that question, if you follow that strategy, wouldn't you end up having lots of funds in your portfolio? Because every time something is down, and if I load up that thing, it is going to make my portfolio very large, right? When I'm talking about the number of funds that I will have.
Absolutely, you're very right. And it has become large in some sense. Because, see, what I believe is, my style of investment is like 80% I do nothing. It's like, this bell curve in the engineering mathematical space, you have
Yes.
statistics bell curve.
Yes.
So I believe that markets at extremes are generally 5% of the time, which is like total 10% of the time markets are in extremes, markets or sectors or themes. Remaining 90% of the time, it's there in that comfort zone. When markets are in extreme zone of greed and fear, that's when you should act. 2020 was extreme greed, extreme fear. 2020 in equities. Uh, Today, I think the same in silver and gold in as extreme greedy right now, right? So if I had positions, by the way, I don't have any positions in gold and silver. I had missed out, but in my opinion, I don't think that I missed out because I never found it cheap to buy in the first place. But still, it went up. So and now it has surely gone into a very greed zone as per my view, and I wouldn't be comfortable adding or doing anything. But if I had money, if I had invested in gold and silver, I would have started cashing out. So on those 5% occasions, you will buy and sell. Otherwise, you will hold. So far, whatever I invested in, that has worked, like China, small cap funds, many sectors. I bought them very cheaply, but they have still not come to my sell zone yet, which means they are not still very, except PSU, which I sold last year. PSU fund that came into my sell zone. See, because every time you are doing a sell transaction, you have to pay 12.5% to 14% capital gains tax. So you have to be pretty sure that either do you have enough, either there is enough greed out there that it's very difficult to make money, or you have a parallel buying opportunity also. Because if you sell, what do you do with that money? So last time when I sold my PSU fund, I knew banking didn't do well, and I knew I'm okay paying 12.5% capital gain tax, but that's still better. I am still making a lot of money after that, and I'm getting a good opportunity. So that's the only one thing that I've done. But all other contract transactions that I bought, I've not sold. I'm sitting on good gains, but I still don't think this is the bubble phase in whatever I have. Like I have decent amount of money in infrastructure funds, manufacturing funds, uh, auto sector, but none of the areas I see it's a kind of a bubble territory.
No, see, I definitely feel that is a very smart strategy. But then now that we are discussing this, and there'll be people who will be listening to us, and many people are going to get fascinated with this style of investing, and they're going to do that. As a responsible channel, I also want to make sure that they have a exit path also, right? Since they'll have a lot of funds, I'm talking about the number of funds, and then there is, yeah, sorry, go ahead.
So I would never recommend this to any investor. In fact, when I do, I like to do it for myself because, uh, as I said, see, you have to understand few things, Pankaj. We have very good source of active income coming every month, so we don't have to worry about our expenses. We don't have to worry about our emergency funds or this thing. I have unlimited patience to wait, and I've not taken leverage, so I can wait endlessly, right? But for other retail investors, because they have limited salary, they have limited corpus, they have expenses coming off, they have a dream to buy a house, they would need this money at some point of time. So they can't have unlimited patience if things doesn't work, right? So even with all our clients also, because we're into it, we don't recommend these kind of thing to 95% of our investors. For 95% of investors, we tell them stick to diversified equity funds where you can expect 12% kind of return over a long term, which is not bad in itself, right? That's almost double than fixed deposit returns. And historically, over the last 25, 30 years, good almost all kind of equity funds have given 11, 12% kind of return, which is comfortably. And if you end up getting 30, 14, that's good luck. You have won 2 more percentage higher, right? But because I'm 24 by 7, I'm 20 years into this industry. I meet fund managers. I read about greatest investors of the world like Warren Buffett and Charlie Munger and whatnot. And that works well with me. I read a lot of books and I find myself very suited for this contrarian kind of investing. My temperament, you can say.
Okay, so but
But it comes very natural to me. But in general terms, it sounds very counter cyclical. It's not intuitive, to most people.
Yes, and just for education purpose, in case they want to do that, the only challenge they'll have is that probably a lot of funds that are there in the portfolio, and they'll have to continuously track those, and then they also need to know the right time to get out of it because their cycle could come and then again go.
Yeah. Because see, in any kind of sector fund, thematic fund, or contra bet, you have to be right on both counts. Entry timing has to be great. Exit timing has to be great. That's how you make very fascinating returns. If one of the two is wrong, then you will still end up making optimal returns. I wouldn't say bad returns because at least one of the entry was right. Like you bought very cheap. And if you sold midway also, at least you're not regretting in the sense like you have made decent profit even after that. So, but if you can get both right, you get a killer return in the process.
Okay, we have already shared with the viewers that it is very difficult to follow because the exit would be difficult for them. But how do you select it? What are the criterias? Let's take the example of today, right? What do you think is really cheap?
So, frankly, today it's a very difficult time. Nothing is cheap. Equities are expensive. Gold is expensive. Real estate, of course, as we see all around, is expensive. Crypto is doing very well. Nothing is cheap right now. But within equities, again, this is not a recommendation. I would not like to say. This is just my view. Uh, of all the sectors that we're looking at, we just find IT sector in a better place compared to other things from price valuations point of view. Uh, of course, there might be a lot of structural problems with the IT sector, and that's why it's 20% down from all-time high. But we believe that hopefully things will become better, and this is looking attractive right now. Okay, so far we've not yet invested, but we're watching it closely. But apart from IT sector, no other sector is coming to our mind that is having this kind of a valuation gap. Almost all others are very close to all-time highs. Mid cap, small cap, everything is very close to all-time highs. So, and we would wait in that case. We have patience. So we have around 15 to 70% money in a cash today. So we'll wait. I'm in no hurry to deploy. See, for me, Pankaj, it's not just India; it's the entire world market that is open. In the sense, anything which is available through mutual fund route, like even China, Brazil, Taiwan, emerging markets fund, Japan fund. We look all those markets and see what has been the recent historical return. And if in last 1, 3, 5 years markets have done very poorly there, the returns have not been very commensurate. We start looking into these more closely.
Okay, thank you. Next question is on China, since you brought this up. China looked very attractive year back, relatively, right? It looked very attractive. So I also invested in China. But then today it is a tricky situation. If you look at the valuation, it is still way cheaper than Nifty. But then when you look at how much it has run up, it has already run up by around 40 odd percent.
Correct.
So at what point do you think it would be appropriate to take an exit call from China? Because you can't stay in China forever, right? There is a lot of uncertainty with regards to government, the way the government functions there.
No, it's a brilliant question. So China for me is never a buy and hold lifetime kind of an investment. In India, there are many mutual funds which is buy and hold for very long term, but China is not certainly one because you don't understand the government, you don't know the economy and stuff. Uh, so China for me has always been a tactical call. Now this tactical position can remain as long as for 8 years, 9 years also, because if it is not played out, I would not sell out in that sense. So, first time when I did China 2014, I started my SIP and I encashed in 2020 Jan, 6 years. Uh, my first 5 years CAGR was only 2%, rather 2% CAGR for first 5 years, and the 6 year CAGR became 17.5%. One more year you waited, markets went like this, your average became 17, and I thought, wow, good return in the last, because last 1 year markets went up by 100%, and I thought, wow, this is in a bubble territory. But let me caution you, when I sold after that, market went up by another 50% from there in China. But I have no regrets because I encashed all that money and put in a small cap fund in Jan Feb in India in 2020. So even that has done well for me. So I got lucky there. Having said that, I again built up my position sometime in I think December 21 uh, in China.
Okay.
Uh, you would recall by Jan 21, China was all time high. Tech index was all time high, and by December it crashed by almost 45%. So I said 45% index level pe crash is a good entry point. Okay. And these are top tech 30 companies of China. So they can't become zero. By the way, when I bought at 45% down, it went to another 45% down from there. Okay. So 10,000 index came to 2,500 odd. Okay. I it was like water in my mouth situation. I went and loaded up double. Uh, so I invested 20 lakhs earlier at 10 rupees NAV. I loaded another 40 lakhs at 5.5 rupees NAV. And 2022 I added in 2025. That has done awesome, amazing investment for me. My 62 lakh has doubled. It's 1.3 CR ke aspas, 27% CAGR for last 3-4 years. But there's still, so the index is around 5,500 or whatever now. 10,000 was the high 2021.
Mhm.
Really, there is a lot of room for it to go. So I'll wait for another 2, 3, 4 years. And when I know in newspapers headlines, everybody's chasing China, everybody's entire world is going to China, you know, so you will get all these feelers that now this has become the darling. Last 1 year, 2 year returns are crazy. Then I'll quietly sneak out from there.
Okay, so basically it would be more about everyone chasing. You don't have a parameter set, like,
No,
when.
no, there is, in the sense, if suppose right now I've been holding for 3 years and my 3 year CAGR is 26%. That's not crazy. My 4 year CAGR in PSU fund was 56% SIP CAGR. This sounds crazy, right? 56% SIP
Yeah.
returns for 4 years is crazy. It is not repeatable. 26% is okay because you bought very cheap. 26% is not that great, and that to 3 year. If 26% returns becomes over a 9 year period, 10 year period, 8 year period, then you had a very good lengthy run of outperformance, and then next 5 years looks to be underperforming. So the moment I see that over a 6 year period, my SIP returns in China or whatever has become 26, 27, 28, maybe I'll exit from there then. So it's a combination of your past returns. It's a combination of fund flows, how much money is chasing, and more so in the last 1 year, 2 year, what till what extent market went up. So you see all of this, and you somehow get a gut feeling that maybe it's time to exit. See, it may so happen that I exit and markets go by another 20%. So I would like to leave some profits on the table also. I don't want to take everything with me because I can't time it perfectly. So I'm okay leaving another 10-15% upwards. And I'm happy if I made this kind of returns because over a 6-7 year period, if I made 25% plus return in some of these opportunities, that's crazy. Yeah. You hardly get these opportunities.
Okay. Uh, Thank you. Since we are talking about China, let's talk about international funds. See, this is the issue that I see, that whenever something is working very well, everyone jumps in, right? So now everyone wants to get international exposure. For some reason, nobody wanted to do it earlier. So if someone has to get an exposure to, let's say, US, because when they say international, they primarily mean US. Right now, the valuation is not good. It has already run up. So valuation is high. But then if somebody has nothing in their portfolio when it comes to US, should they be adding it right now, even at higher valuation? And if yes, then what are the avenues to do so?
So two things. One is diversification from theory's sake. So yes, if you have nothing in uh, in in US. See, what I'm saying has very two different connotation. What I do for myself is very different from what I would advise to my investors or the viewers. Uh, because in my own case, I'm answerable to nobody. So, uh, almost all my life, I had never exposure to US till date, except through Parag Parikh fund. They had whatever, but I never went into any US based fund on my own ever. Till date. And you may say I have missed out on rally, what US has given in the last 15 years, but I've made in India. I've made enough returns in India too. So again, I have no regret and I have no FOMO. Okay. Whether it is US equities, whether it is gold in the last 1-2 years, I made enough returns in China in my case, right? So for me, uh, I will go where the returns lies. I am not married to US. I'm not married to India. Of course, I'll say I'm married in a sense because you live here, you have a bias and you see economy around you. So you will always have a bias. And again, as long as I see returns in India, I will, yeah, see, there might be some case where I can see India is very expensive from equity markets point of view, very expensive. And if other global markets are looking cheap, I don't mind cutting good amount of exposure from India and going other way. If all other markets are also expensive, but gold is cheap at some point of time and equity is expensive, I don't mind cutting equity to a decent amount and go to gold, So I want to go where opportunity lies. Okay. But but India in the last 8-10 years has looked expensive, has looked this thing, but has never looked bubble to me. I wouldn't say bubble. Bubble is a very strong word. Uh, Today, I feel there is And I personally feel it's a bubbling gold and silver. I feel the way it has gone up, right? But if I were to advise to my investors or any, if you have US exposure 10-20%, that's not bad, because think that way, Pankaj, you are consuming all the products every day in, day out. Tech products, all MNC products, everything you're consuming. So in a way, you are the owner of what they are producing. Secondly, the good advantage is you get dollar diversification. You're buying, you are hedging against dollar also. So 2 to 3% every year, that depreciation, currency depreciation, you are there, right? But one thing, having said that, I want to tell you, even last 15 years, US markets have gone through amazing returns. But before that, 10 years, US markets were bad. So I'm very skeptical. Next decade of US will not be as rosy what the way you saw in the current decade. So I always tell this to investors that, come, even if you're investing in US, go with this mindset that your returns will be moderated. 10 to 12% is what you should expect in INR. If you get better, then again it's good luck continuing. But maybe 10 to 15, 20% exposure you should have through S&P 500 or Nasdaq, through SIP. You can keep. There's nothing wrong with that.
Okay, so again, you're talking about buying those ETFs that are there, right?
You have index funds or whatever, active funds, whatever, in whatever form you buy, doesn't really matter much. The another problem right now today is the limits are closed in most of these funds. So anyway, through the normal mutual fund route, it is very difficult to invest through this thing. The only other way you can buy is through LRS. 250,000. You can invest in ETF. There are platforms available in Indian markets. That is how, or Gift City route is also there. These are two ways. But in mutual funds, because you have this $7 billion limit by RBI, almost all funds are closed, and very few funds have leeway to invest in the international markets.
Okay. So now coming to the next question, right? I'm going to talk about the issues, dilemmas, confusions that investors face. Most
Correct.
of my viewers are seasoned investors. Let's take a scenario, right? So let's say fund performs very well, then underperforms for 2, 3 years. The fund manager changes, but most investors continue holding on because either they hope for a turnaround or because of the taxation, or sometimes they think that the style is out of flavor right now, it is going to come back.
Correct.
The point is, they tell all of these to themselves just to not sell the fund. Now, in some cases that could be right, but in most of the cases it is not true. So what is your take on that? I'm sure the investors that you handle, they must have the same kind of
Yeah,
issue.
yeah. No, it's a difficult question, frankly speaking. There's no easy answer to this. Tax is certainly a big factor, because the moment you take a sell decision, you end up paying 12.5% capital gains tax. Okay. Uh, so you already reduced that kind of return from your portfolio, right? And of course, you are betting on another fund. There's no guarantee that new fund which you choose will outperform what you have just exited, right? Might go still wrong here. Uh, what I've seen of 21 years experience in this industry, in a general diversified equity fund, as long as you have identified a decent fund manager who has spent 15, 20 years in the markets, okay, because we have the luxury to talk to them. And when we attend 2, 3, 4 of the sessions, we can kind of make it out that how they sound, in the sense, are they reasonable people, in the sense, are they talking more jargons and really do not mean anything, or are they actually talking the way we think in a normal manner? And if we think that the logic and reasoning is right, they know their craft well, we don't then mind. And if that and it reflects in their track record, right? If somebody has spent 20 years in the markets, they have a good track record of the funds they have managed in the past. We don't want number one, number two funds. We don't want bottom. We just want consistent. As long as they are in top 50 percentile, so you divide, if there are 100 funds in the market, as long as they're in the first two quartile, which is above average, 50% performance, right? I think they're doing a decent job. I'm not worried. So I will not change my fund manager. And by the way, Pankaj, I have in my own family's portfolio, I have fund for last 15 years, 14 years, 13 years, normal diversified equity funds, where today, when I bought the fund, maybe those funds were five-star funds when I bought them, because that time I might have looked at the ratings, the past performance. They are no longer five-star, four-star. Many of them became one-star, two-star, and then now again come up. But the average return has been on 13, 14, 15%. diversified equity fund I'm talking about. Okay. And again, as I said, that's not bad. 14-15% return is not bad. So I'm quite okay with diversified fund performance. I wouldn't like to touch as much. Sure. But these sector funds or the funds that have taken active calls are more tactical calls in the sense if the strategy plays out, if the theme plays out, then I'll change. The only condition where I'll check out a diversified equity fund is when I know that last 1 to 3 years performance of one particular fund has been rock star and they've beaten the benchmark by a good 10% alpha and every cases. They've been ranked number one across last 5 years, 1 year, 2 year, 3 year, right? Then I know that next because they're going to get a lot of money in the new cycle, in the coming cycle. So suppose if your fund size is 5,000 crore and you've been number one, two, one in 1 year, 2 year, 3 year, 5 year, and 7 year, in next 1 year, your fund size will go up from 1,000 to 5,000 crore. A lot of money. So that will make sure that your performance come back to me, and then you'll have miserable years also in the going years. So if I know for sure that this fund has done supremely well, maybe I can kind of go out from this fund, go for another fund that has not performed in the last 3 years, 4 years, 5 years.
So when you'll be doing that, would you stop your SIPs there or would you sell it to get into another
No,
fund?
yes, I'll sell the fund because see SIP I might still continue because SIP mein my new money is going, which is hardly anything now.
Mhm.
But if my course has become like, let's say, for last 7 years, I'll give you one example. I don't want to name the fund. Last 10 years I was doing in SIP. In 21, 22, that fund was worst performing mid cap fund in the country. Worst, 29 out of 29 rank, right? But it never bothered me. I said, "Koi farak nahi padta hai. It will come back." And 2 years later, it was the best performing mid cap fund for good 2 years. And it was outperforming the index and category average by 10%, which is crazy. Okay, so my 10-year CGR in that fund, 11-year CGR at one point was 25%. Now it has come to 21%, which is not bad. 10 years, right? Ideally, I should have exited from that fund, but because that fund was linked to my goal, and generally I do a lot of podcasts, so I want to show the long-term journey of my goals. Knowing that this fund is not going to outperform in the next 2 3 years, I didn't exit it, right? Because I had different points to prove of this example. But had this fund not been linked to any goal and not been showing, I would have exited this fund from my portfolio because I knew that this fund is going to underperform for the next 2 3 4 years. And at least I told my investors कि boss आप तो निकल जाओ, मैं नहीं निकल सकता, मेरा मजबूरी है, मुझे मालूम है मेरा अंडर परफॉर्मेंस होगा, बट आप तो निकल जाओ यहाँ से.
So next question is about index funds. So there is this thing that goes in the media that you should not have a lot of index funds because there'll be portfolio overlap and there is no point of holding multiple index funds. Again, I'm bringing up your style that we talked about earlier. That whatever looks cheap, I'm going to invest in that. So is there a downside of having lots of index funds other than the tracking issue? Because majorly the argument is if you're going to buy the entire market, rather buy an index fund because you'll be paying a lesser expense ratio. So if I'm buying multiple index funds, I'm still paying lesser expense ratio. So even if I have multiple, it doesn't matter, right? If as long as I'm able to track and I can take decisions based on the performance of those indexes.
So I have a very clear philosophy here. So for large number of investors, they should just invest in Nifty 50 index because that's anyway 70% of the market and it's the barometer. And with less volatility, you can make whatever 12, 13, 14%, whatever it is given, and you can sleep with that. आपका पैसा अच्छा बन जाएगा. If you want to be a little more aggressive, you want to buy the entire market, then go with Nifty 500. That's the next best option because you get mid and small cap also there. और साल का 2% शायद आपको ओवर लॉन्ग टर्म आपको ज्यादा अल्फा मिल जाएगा ओवर 15 ईयर पीरियड इफ यू आर मोर एग्रेसिव इट विल बी मोर वॉलेटाइल. या तो आप चाहे तो पूरा 100% पैसा एक सिंपल एनएससी 500 फंड में डाल दो. दैट्स मोर देन इनफ. इफ यू वांट टू बी लिटिल मोर एडवेंचरस लाइक मी एंड काइंड ऑफ प्ले टैक्टिकल पार्ट, तो मे बी 70% आपने वहां डाल दिया विच इज योर कोर पोर्टफोलियो. 30% पैसा टैक्टिकल जो है यू कैन प्ले अराउंड विद बैंकिंग सेक्टर एलोकेशन फंड passive, I'm talking about passive only, or IT sector, or a PSU, or a auto, from time to time, and then shift within that 30% contra calls. Uh, but that requires active monitoring on these sectors' performance and timing, entry and exit. But if somebody can do it, even that could be a good strategy. See, hota kya hai, in the two strategies, the difference in the long term will maybe just 2% higher in the more aggressive strategy. Are you getting my point? जहाँ पे मैंने in and out किया
But 2%
70,
is a lot over a long period.
but yes, but 2% is a lot, right? But वो 2% के लिए जो volatility आप देखोगे ना, तो आप, if you're not able to handle that, then you'll go other way around. You'll make a lot of mistakes, and आपका वो जो index में भी रिटर्न आता है उससे -2% और कम आएगा, मतलब, because you entered and exited the wrong time. So on paper, it sounds very good, but believe me, it's very stressful to handle that when things are not going your way.
Okay. But yes, so there is no.
But even index fund is a great strategy. I mean, I'm not saying कि आपको active funds में जाना है. Of course, my portfolio so far is heavily active because I still feel 10 साल में इंडिया में अल्फा है, और अगर थोड़े ढंग के फंड मैनेजर्स टाइमिंग करके आप उनको सही से कर सकते हो, विच वी हैव टाइम एंड नॉलेज, तो हमें लगता है, और हमने हमारे पोर्टफोलियो में बैक टेस्टिंग भी की है. वी हैव सीन रिजल्ट्स दैट आवर फंड हैज outperformed Nifty 50 or 500 over a long period as a portfolio. So as long as we get this data, it is proving our thesis, we'll go. The day our data tells us no, we are not able to perform index, we'll switch to index then. And by the way, just to try it out, we have some money investing in a small cap index fund also to see which makes sense, that kind of thing. So what, जब तक trial and error नहीं करोगे, you will not know what is working and what is not.
Okay. Next question is for investors who want to make sure that they are not buying anything expensive. If somebody has exposure to primarily large caps and they want to get into mid cap and small cap too, the valuation is still very high. Would you recommend them to go for multi cap right now, or would you ask them to wait and then whenever it is cheap, not cheap, at least at fair valuation, they can jump in at that time?
See, multi-cap to me is one of the best categories of mutual funds. Generally I like 2 to 3 categories in mutual funds, which is suitable for most kind of investors. A flexi cap category, which is of course more towards large cap because of the size. The second category which I generally like is large and mid combination, right? And third is multi cap. So agar somebody has a very clear view कि 10 years I'm not going to touch this money, then आप उसमें SIP कर दो, चाहे लमसम डाल दो, कोई फर्क नहीं पड़ता अपना कुछ. Even if you're buying little more expensive, see, one thing, try and understand. Many people get wrong here, right? कि लमसम मतलब जिंदगी भर में मैं ये पैसा एक ही बार डालूं, उसके बाद कभी डालने वाला नहीं. You may not be doing SIPs, but हर साल आपके पास कुछ पैसा, as long as you're earning money and if you're smart, you're going to keep adding money in your mutual funds. So rather than doing monthly, because I'm telling this because there are a lot of business owners who can't do monthly SIPs like salaried people, right? But ऐसा नहीं कि आज ही मेरे पास एक 50 लाख था और मैंने डाल दिया, जिंदगी भर में और कोई टॉप अप नहीं करने वाला. So you might be doing 20 lakh top up next year, then another 10 lakh top up third year and fourth year. In the very long term, and as long as you sit there for 10 years, 15 years, that's a yearly SIP in some sense. Not of even amount, but it's still an SIP because you have been adding at all levels. So even if you put lump sum or SIP in a multi-cap fund today and make sure that you sit there for 10 years, you're going to create decent returns, whatever 12, 13, 14 jo bhi aata hai. See, as I said, now today markets are little expensive, but they're certainly not in the bubble zone for sure. 10%, see, market moves like pendulum. The fair value zone is in the center. Today market 10% expensive. 10% is very normal. Markets can remain irrational longer than we can, remain solvent. So अगर 100 is center, markets can remain at 200 level for a long time also, right? So 200 in our opinion is bubble, but even in bubble zone they can remain for a long time. Like Nasdaq अभी आप देख ही रहो, Max 7 देख ही रहो, they have defied all kind of logic, right? तो बट इंडियन मार्केट मुझे आज लग रहा है 10% एक्सपेंसिव है, तो ठीक है, अब मैं वेट करूं कि जब तक वो फेयर वैल्यू पे आए और शायद 4 साल में फेयर वैल्यू पे आए नहीं थे, तो आई वुड हैव लॉस्ट लॉट ऑफ अपॉर्च्युनिटी ना। तो ठीक है, मैं आगे डाला और मेरे डालने के बाद 15% और करेक्ट हो गया। इफ आई हैव मनी, आई I'll average it down so that I make better returns in that process.
So that wraps up part one of our podcast with Mr. Gajendra. But we are just getting started. In part two, we dive deeper into the art of asset allocation, how to build an all weather portfolio, smart debt strategies, and much more that can transform the way you think about investing. Make sure you hit that subscribe button and turn on the notifications so you don't miss the next episode when it drops. And please do consult a financial advisor before making any kind of financial decision based on this video. And thank you. Have a blessed day ahead. Bye bye.